Okay, so now we're going to go through a pretty exhaustive, comprehensive example. It's still only going to cover 3 years, but we're going to have both deferred tax liabilities and deferred tax assets along with permanent differences, and so we get to kind of bring everything together in this example. All right, so we have a company. They have pre-tax financial income from 2020 to 2022 and have a tax rate of 35%. In this case, we're going to have 3 differences between U.S. GAAP and the Internal Revenue Code. The first one is the handling of a piece of equipment that was purchased on May 1st, 2020. We use straight line depreciation under U.S. GAAP, and under the Internal Revenue Code, it's just depreciated by a fixed amount each year. When it comes to the receivables, you can see that there are receivables at the end of each year that are collected in the following year, but under the Internal Revenue Code, the revenue related to these receivables is not recorded until it's actually collected. And so again, we have a timing difference there. And then finally, we have this municipal bond interest. And the municipal bond interest is different than the first two. A couple of things that are important. First of all, eventually all the depreciation for the equipment is going to be recorded under both systems. And so the total depreciation expense is the same, which means the ending book value of the equipment is going to be the salvage value of $10,000 under both. With the receivables, eventually the receivable is recorded as income under both systems. It's just that the timing is a little bit different. With the municipal bond interest, it's a little bit different in that it is recorded as income under U.S. GAAP, but it is never recorded under the Internal Revenue Code. And so what that means is instead of being a temporary difference, the municipal bond interest is a permanent difference. And as we've already mentioned more than once, only temporary differences result in deferred tax assets and deferred tax liabilities. And so while this interest represents a difference in income, it will not have an associated DTL or DTA. All right, again, just as we had always done, there are 3 things we need to do. First of all, we do need to calculate our taxes payable, and to do that, we reconcile pre-tax financial income to taxable income. Then we calculate any changes to deferred tax liabilities or deferred tax assets. Again, we have to calculate any temporary differences between GAAP and the Internal Revenue Code for each specific item. So in this case, the equipment and the receivables will each have different things going on. And then finally, we derive the income tax expense. It becomes a plug in the tax-related journal entry. And admittedly, this is actually one where this approach is helpful because you don't have to worry about that municipal bond interest as directly. Okay, so now we're focused on the information for 2020. Of course, we have our pre-tax financial income. We have the purchase date of the equipment along with the method of depreciation under both systems. We have the receivable and we have the municipal bond interest. So we're going to start by calculating our income taxes payable. We start with pre-tax financial income or GAAP income. And I'm going to kind of use a 2-step approach to adjust for the depreciation difference. First, I'm going to add back the GAAP depreciation, and so what that gives us is the financial income absent the GAAP depreciation. So we add back the $30,000, and again, we use straight line depreciation. In this case, it's a 2-year asset. The total depreciable amount is $90,000, so that would be $45,000 per year. However, we only held the asset for 8 months in 2020, and so we only have $30,000 of depreciation in 2020 under U.S. GAAP. Under the Internal Revenue Code, it's a fixed amount of $50,000. So again, we're trying to get to our Internal Revenue Code taxable income, so we need to account for the depreciation under the Internal Revenue Code. And so you can see that in total there was $20,000 more depreciation under the Internal Revenue Code compared to U.S. GAAP. And so that kind of captures the difference in depreciation in 2 steps. We also need to subtract the 2020 accounts receivable balance. Again, that would be revenue recorded under U.S. GAAP. That is not going to be recorded under the Internal Revenue Code until 2021 when it's collected. And then finally, we do need to subtract the municipal bond interest because it is income under U.S. GAAP, but it is not income under the Internal Revenue Code, so we need to subtract it out. So that gives our Internal Revenue Code taxable income of $251,100. We apply the tax rate, which gives us our income taxes payable of $87,885. So our next step then is to think about the DTL or DTA related to the equipment. So we start with the book value of the equipment under US GAAP. The original cost is $100,000. There's $30,000 of depreciation, and so the book value of the equipment is $70,000. The same piece of equipment under the Internal Revenue Code has a book value of $50,000. Again, same cost basis, but a different amount of depreciation under the Internal Revenue Code means that its book value is $50,000. So there is a difference of book value of $20,000. Notice that in this case, the book value of the equipment under US GAAP is more than the book value of that same piece of equipment on the Internal Revenue Code, which means there is income related, or there's more income under US GAAP compared to the Internal Revenue Code. And that difference is known as the future taxable amount of income. And if you remember from the earlier lectures, whenever you see a future taxable amount of income, that means there is a deferred tax liability related to this item rather than a deferred tax asset. So we apply the tax rate of 35%. Once we do that, we have the balance in our deferred tax liability. We compare that balance to the previous balance, and of course this is a brand new piece of equipment, so there is no previous balance, which means the entry amount to the deferred tax liability is an increase of $7,000. We walk through the same process for the accounts receivable. There is a book value for the receivable of $2,400. There is no receivable under the Internal Revenue Code. Therefore, the difference of book value is a positive $2,400, and similar to the equipment, that difference represents a future taxable amount of income, which means again we have a deferred tax liability. We apply the tax rate to the book value, difference in book value. From there, we get our balance in our deferred tax liability of $840. We compare it to the previous balance, which in this case is $0. Okay, so now we have to get to the journal entry on December 31st, 2020. The first thing we start with is the income taxes payable, which of course is a credit of $87,885. Then we also have the increase in the deferred tax liability related to the accounts receivable, and that's a credit of $840. And then we have the increase in the deferred tax liability related to the piece of equipment, and that is a credit of $7,000. And from that, we derive our income tax expense of $95,725.